Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. Today is Monday, it's the 20th of June, 2022. Hope everyone had a terrific weekend. Just want to bring up the high-risk investment warning. I'll keep this on screen for a few moments, and then I'll bring up the commentaries disclaimer. Hey Shadrach, welcome back. Very, very nice to have you on the webinars again. Thank you for joining. Good morning, Zanetta. Hope you are well. Thank you to everyone for joining this morning. And let's just bring up our market commentaries disclaimer. So I just want to remind everyone of the Crypto Minute on Wednesday. I want to keep the crypto separate from these webinars. It's a compliance thing. So if anybody is interested in cryptos and Bitcoin, join us on Wednesday. The weekend certainly was interesting. I'm going to just bring up our references. FXCM Market Scope 2.0, CNBC.com. We're going to read the morning note in a moment, and then we'll take a look at TradingView. This is the yield curve, pretty close to inverting. We haven't quite inverted yet, but we're very flat. Alrighty, let's take a read through the article on CNBC. It's just the European markets opening article, and the headline reads as follows: European markets set for lower open as investors reflect on economic uncertainty. European stocks are expected to open lower on Monday after a tumultuous trading week last week. The lower open for Europe today comes after a turbulent week of trading on the back of central bank action last week. The US Federal Reserve raised its benchmark funds rate by 75 basis points. This is the largest hike since 1994. And then the Swiss National Bank surprised markets with its first hike since 2007. And then the Bank of England implemented its fifth rate rise in a row. Following an emergency meeting last Wednesday, the European Central Bank also announced that it plans to create a new tool to tackle the risk of Eurozone fragmentation, a move aimed at assuaging fears of a fresh debt crisis for the common currency bloc. Stateside, the S&P 500 and the Nasdaq Composite bounced on Friday as Wall Street attempted to find its footing following a brutal week of selling. But all the major averages ended the week in the negative, with the S&P 500 posting its worst week since 2020. Markets in the US are closed on Monday for a holiday. Overnight shares in Asia Pacific were mixed in Monday morning trade as investors monitored market reaction to the release of China's latest benchmark lending rates. There are no major earnings releases in Europe on Monday. Germany is set to release its PPI for May. All right. Hey Ada, morning to you. Nice to have you on the webinar as always. All right, so just taking a look at the US 10-year, the twos tens, right? So this is just generally the yield curve, I think most often consulted in terms of inversion. Inversion takes place when we drop below zero. This horizontal is not quite on zero, is it? Yeah, it is. Okay, there we go. All right, so we're not quite inverted yet, but we're pretty close. So we're very flat. Now, when we talk about an inversion, you know, we're not talking about a little blip over here. This over here doesn't count. We're talking about an inversion. Like it spends a fair amount of time negatively sloped. That's what we are looking at, which hasn't quite occurred yet, but we just want to keep an eye on that. And the reason we want to look at yield curve inversions is because they precede recessions. Yield curves inversions precede recessions. It doesn't guarantee a recession, okay, but all recessions have been preceded by a yield curve inversion, right? So that's why we look at it, because if it inverts, well, then it increases the probabilities of a recession. Hey, Howard, had a terrific weekend. Hope you did as well. All right, so what we want to do is let's just start off by taking a look at the DAX. We'll run through the DAX, and then I want to just go through some market psychology. And I want us to be on top of this market psychology. All right, here's the DAX. So yes, I beg pardon, last week we had identified the lower peak. Here's the lower peak, lower trough, right? So lower peak, lower trough, that's a downtrend, okay? So the DAX is trending down. It's not as vicious as the US markets, but it's vicious nevertheless. Take a look at the stochastic here. The stochastic's rolled over, and now it's heading towards the 20 area. And if we head to that 20 area, you know, that is very much a sign that the momentum is biased to the downside. But when I say biased to the downside, the lower quintile, under 20, that's strong momentum down. That means that there's a real risk of a pressure being applied, a serious pressure being applied. Now, this is a weekly chart, so it's a primary trend. Just to give you an idea of what we are talking about, I do this all the time. I just want to do it again. There's no such thing as overbought and oversold on a stochastic. It's not the way if you just run through the mathematics, it's impossible to be overbought, oversold on a stochastic. Okay, so the idea is when we cross into the upper quintile, well, that's very strong momentum. When we cross into the lower quintile, well, that's going to be very strong momentum to the downside. So the idea is watch out. Okay, watch out below. Do we reach that 20 area? And if we reach it, is it going to be maintained? Because you can see reaching it in of itself, that's not the deal. So if we go back to the if we go back to 2020 when we went into lockdown, we hit the 20. Of course we hit the 20 because the momentum to the downside was very strong, but it was very brief. And it wasn't sustained, and it actually turned out to be a terrific buying opportunity, but it would have been a completely different story if it had stuck around the 20 area. Okay, so this looks very dangerous to me, okay, because it seems to be a little more ordered than just that sort of capitulation, that the floor disappearing in 2020. This seems to be more orchestrated as the bear market unfolds, as the economics unfold. Let's complete the analysis of the DAX, but I want to come back to what I've just said: the bear market unfolding, the economics, the macroeconomics unfolding. I think that's a huge focus. Okay, so let's just complete the technicals, then let's come back to the fundamentals. So let's go down to the daily chart. And the daily chart here is in our weak area. What do I mean weak area? Well, we can put zones in. So let's put our zones. Zone 1 is our bullish area. Okay. Zone 2, that's our neutral area. Okay. Zone 3, that's our bearish area. Where are we? We're in the bearish area. Okay. Where is the momentum? Where's the downside momentum? It's in the lower quintile. Okay. That's dangerous. That's dangerous. Okay. If it stays in the lower quintile, there is going to be a pressure applied to the downside. Now, let's add in the Heikin-Ashi here. I want to just see something. So the Heiken Ashi is just a trend following indicator. Just want to see something new. All right, I just wanted to see if there was a bit of blue here. Okay, there isn't any blue, but basically, you know, when we look for dips in the uptrend, well, the Heiken Ashi is a good trend following indicator to keep an eye on. So here's the dip. There's red in the uptrend, then it moves up. When we're looking for this is 2022. Let's just see. There's no real rallies that I can see in the. Here's a rally in the downtrend, but so I just wanted to see if we had some sort of rally in the proverbial downtrend. So we don't really have that on the Heiken Ashi. Let's just take the Heiken Ashi out. Let's go back to just normal candlesticks. Let's do the analysis like this. We're in zone 3. Okay, let's acknowledge we're in zone 3. We've got a very dangerous looking stochastic. Let's acknowledge that the stochastic's looking quite weak. The primary trend is down and our momentum has hinged. Okay, so that's all where we are when we come down to our daily chart. And the daily chart here is where we try and assess any timing opportunities. So the timing opportunities at the moment seem to be absent. What do I mean by that? Well, if the daily is weak and the weekly is weak, well, then we want to see if the resistance levels holds. So R1 is our first level of resistance to keep an eye on. Okay. Do we get through the R1 level? Well, then R2 is going to become a key interest. R3 is quite far away. I'd be quite impressed if the market made it all the way to R3, but let's just see the resistance at R2. How are we looking there? Okay, so R2 looks pretty interesting. Here you've got support at that R2 level. Here you've got support at the R2 level. Here it breaks below, actually goes to R1, but we'll just say that it was a failed break to the downside. Here is support. And now there's this pivot overlap. So again, support turning towards resistance. I think that's a fair level to watch. We call that the principle of polarity. So what I effectively am doing here, I'm saying, look, we've got a downtrend here. Okay, look, we're in our bearish zone here. If that is the higher time frames, then I ask, where is the logical place for a price reaction on the hourly? Understand the logic? If we are trending down, fine. Where is the logical place to look for a reaction? Well, probably this R2 looks quite interesting. It may happen soon. It may happen at R1. Okay, R1 does have support there, resistance there. So it may be, but if it does happen at R1, that's more bearish because the bulls just didn't have the strength to take it even as far as R2. But sort of the R1, R2 areas, I think would be areas, an area of resistance, a key level to keep an eye on. Would I be looking to go long right now? No, I wouldn't personally. Don't take that as advice, but on my own account, it's not something that is what I'm looking to do. I'm looking to see where the key reaction levels are, given the fact that we are in a primary downtrend. The R1, if it reacts, the R2, if it reacts, well, we'll measure that with the EMAs and we'll measure that with the stochastic. Clearly, we're not getting any sort of signals there at the moment. All right, so that's the DAX. Let's just take a look at dollar as well. Okay, similar analysis, top down. Higher trough, higher peak. All right. We were actually slipping out of the 80 level at the end of last week. That hasn't happened. It's actually curled back up. So we want to keep an eye on the dollar. Dollar is the first link in our chain. The first link in our chain, right? So keep an eye on that. Here is that potential dip in the uptrend. Okay, so but we're in zone 1. And now, well, here's a key level to keep an eye on. Is the central pivot going to hold, or is it going to drop to S1? So there's our levels. Do we get the trend following indicator and the momentum indicator suggesting these are levels of support? So you can see dollar now looking fairly interesting. All right, let me just take a look at some comments here. Just from Anna, announced yesterday evening on German news, coal electricity plants about to be decommissioned, being kept on reserve, and also gas saving measures. All right. All right, so let's just take a look at the thing, which is let's go back to let's do it on the US 30. It's actually because the trend here is pretty obvious. Okay, lower peak, lower trough, lower peak, lower trough, lower peak. Hey, we can add in the next lower trough. Okay, so here's the next lower trough in the series. Okay, so take a look at the stochastic. We're getting pretty close to this level here. And now the question we've got to ask ourselves, well, how much lower can we go, right? At some stage, the stock market's going to represent good value at some stage, as will the various assets out there that are getting hammered. And the question is, well, are we at that level now? And the answer to that is, well, no one really knows. but we can try and make some sort of assessment. It's the 20th of the month. You guys know I think that the COPOC is a key focus at the moment, but it's a monthly. COPOC's used on a monthly, so we've got 10 days before we can really get a signal off of COPOC. So this is the Dow Jones. We'll just add the COPOC in here. This makes this easier to see. All right, so COPOC is still above 0. So have we reached absolute value? Well, not absolute. Have we reached relative value levels according to the COPOC? No, we haven't. Does that mean we are precluded from going up? No, it doesn't mean that either. But the bear markets usually line up quite nicely with the COPOC indicator. We don't have that on the Dow yet. If we go through to the DAX, they're a little closer on the DAX. Okay. A little closer on the DAX, but not there. So you know, there could be some pain still to come, but we're getting close to these relative value levels technically. Fundamentally, that's a different story because we're still getting required rate of returns adjusted for higher interest rates. So, but we're not going to tackle that today. Would the pivot levels also work on crypto, or would fibs be better? I would imagine that they would work again, I just want to. I'm going to keep the cryptos limited to the crypto minute on Wednesday. It's just a compliance. It's a compliance thing, but I would imagine that pivot levels probably are watched there as well. I would certainly watch them. I don't see why people wouldn't watch them. So now the question is, let's go back to the US 30 here. So now the question is, what would get us below zero here? What would get us below zero? And we're approaching this on a technical basis. We're not looking at this on a fundamental basis just yet, but we're starting to bring in some macroeconomics into this. And it really comes down to the stages of the bear market. And the stages of bear market are, there's three stages, and we're going back to we're going back down to the Dow theory. Okay. So it's not the best. It's not the best diagram I've ever drawn, but anyways, it will do the job. So first, the first phase of a bear market. Second phase. Third phase. Okay, so there's your bull market. First phase of a bear market. Okay. Abandon. I spelled this right. Abandonment of hopes. I hope I spelled that right. Here we go. Abandonment of hopes. Okay. And the second stage. And the last stage, panic selling. Okay. Those are the stages. What were you saying about required rate of return and high interest rates? So as interest rates go higher, remember the time value of money formula. As interest rates go higher, your rate of return is higher. If you can earn 5% in the bank, risk-free, well then the risk markets better give you something higher because there's a higher risk, right? If the interest rates in the bank go up to 7%, well then the risk markets better give you something higher because there's higher risk. Okay. All right. So these are the stages. So clearly we've got to deal with the bear market because we're in a bear market. And we've got to try and figure out, well, which stage are we in here? Are we in declining earnings or panic selling? So the declining earnings probably hasn't fully fleshed itself out yet, I would imagine. I think that, just what we talked about perhaps a week ago, perhaps 2 weeks ago, just that higher inventories to sales ratio. I saw a couple of charts of that on Twitter. It's really getting out, it's sparking up. So inventories are moving up. So what does dead inventory mean? It means, you're not selling that inventory. Well, that's where your earnings start. It starts on the top line. You know, what's happening to your sales, your revenue? If revenue is coming down, how's that affecting earnings? Now, clearly, there can be some sort of variable cost control. Okay, so if there's variable cost control, you know, there may be some way to salvage earnings, but I think that top line is starting to really look flimsy. So we could very much still be part of the second stage, that declining earnings. And if we're still in that declining earnings, well, then we haven't hit panic selling yet. You understand? So if we haven't hit panic selling yet, that's kind of a scary thought, because we have been hammered for this first 6 months of 2022. This over here, deciding whether we are deciding whether we are in stage 2 or stage 3, there's no real absolute about it, and there could be some overlap. Clearly, there could be some overlap, but I'm not convinced we've got into this sort of panic selling, even though we've seen mass selling over the last month or two. I'm not sure it's actually that panic selling, that final capitulation. Now I know that we're going to leave Bitcoin analysis really to Wednesday, but what I will say today is I was just taking a look at some of the comments on Twitter yesterday, and by the actual comments, what if the Twitter comments have anything, now within the panic selling stage, certainly hasn't been hit. You see what panic selling is? Panic selling is absolute capitulation. Okay, it's when you really have been beaten down, that there's just, you want nothing left to do with the markets. That's what panic selling is. I'm not sure we've got that. Panic selling was 2000 to 2002. The internet stocks that came out of the turmoil of 2000 and 2002, those were the real ones to keep an eye on. But how many hundreds of companies disappeared during the tech wreck? Capitulation happened in 2008. Okay, I'm not sure we're seeing that sort of capitulation, that final sort of panic selling stage. The final panic selling stage is it's literally a knockout blow. It's like nobody wants anything left to do. The novices got really nothing left to do with the market. So if there's still an indication that people are holding out for hope, and Twitter seems to suggest to me that people are holding out for hope, well, that to me suggests that we haven't seen that panic selling yet. Now, this is all subject to correction. It's just something that I noted yesterday when I was looking at the comments. Assuming we haven't seen that panic selling stage, well, then that would tell us something about the COPOC indicator, wouldn't it? It would say that, well, after that panic selling should be under zero. And when we kind of under that zero, you know, the novices want nothing left to do with the market. They've been hammered left, right, and center. You know, they've tried their best and they've been knocked out. That's when the pros are accumulating, because these are still good assets, but they are dirt cheap prices. Okay, that's what the pros are waiting for now. You know, so think about it now in terms of the macroeconomics, in terms of if you're a portfolio manager, okay, okay, and you reckon that there's still some declining earnings, maybe you're holding back. You just want to get through that declining earnings stage. Then you're probably holding back because, wait a second, there's going to be a sort of a panic selling, a capitulation. I'm going to get some really good stock at absolute bargain prices. But that's what the COPOC indicator is all about. Okay, that's what it's all about. Now, what we're talking about here is theoretical. it's theory. Will it play out that way? And the answer to that is we don't know. Okay, we don't know. There may be, we may have, this might be the panic selling over here. Remember, we look at the monthly. Maybe this is the panic selling. Maybe the portfolio managers come back in and the COPOC actually turns up before it reaches zero. I mean, that can happen, okay? But if we go sort of strictly according to the Dow theory, I would suggest perhaps we only are in stage 2, which is a very scary thought, because that means that as much pain as we've seen now, well, if we hit that panic selling, it's going to really become intense. It's when all hope is lost. It's when all hope is lost. So you kind of have the abandonment of hopes here. So again, I don't want to talk too much about the cryptos. It's just the cryptos are such a sort of you know, it's the perfect candidate for this type of discussion. But it's kind of like you kind of abandon your hopes here, but you're still holding on to your like last threads, and then that panic selling just kind of knocks the wind out of you. You just have no more heart left in you. That's kind of what we're talking about here, right? It's like all the ridiculousness is flushed out of the market. So going back to 2000, 2002, it's like, well, the companies operating out of garages with no assets that had some sort of hope attached to them in terms of value, that gets completely flushed away. Is like anything where there's a pretense of intrinsic value, that gets all flushed away. All the gurus, okay, of the prior bubble, they get flushed away, never to be heard of again. All of that is part of the panic selling, okay? Chris says, what about looking at oil? What about looking at oil? Was there a panic phase there? Yeah, so certainly there was. Let's see if we can pick it up here. All right, so let's just put in our 0. Nice one, Chris. Here we go. So here's the capitulation here. Okay. This is the spot price. Okay, this is the spot. So WTI never went negative. It actually never went negative. The future went negative, but the spot price can't go negative. Your spot can't, but the future can go. Your futures went negative. But this is your kind of final capitulation here. This is your panic. This is your panic selling, right? It kind of it took out anyone that was looking to pick up oil. Anyone that was looking to pick up oil just had the wind completely knocked out of them, because the price action just put everyone into loss straight away. But then what happens is it picks up. It picks up, okay. And if all the bottom pickers just had some patience, they would have still, whatever they were planning to do, you know, would have paid off tenfold, you know, or not tenfold at this stage, but certainly but manyfold. All right. So the idea here is, I'm not sure we've hit this total capitulation, this panic selling. Certainly the COPOC indicator doesn't suggest it. Should we be beholden to that? No, we shouldn't be beholden to that, but we're going to use it as a model going forward. Why are we going to use that as our model going forward? Because it's such a complex beast. It's such a complex beast, okay, that we have to try and view it in some sort of ordered model, and when the model turns out to be incorrect, adjust so that we can still try and keep on top of this huge beast of, that's called the market. There's just so many variables. So that was a good one, Chris. So that's how we're going to start the week. Okay, the week is, I'm not sure if we have hit the end of stage 2. If we haven't hit the end of stage 2, then there's still some sort of adjustment to take place just in your PE ratio, right? And perhaps we'll take a look at some PE ratios and see how they are reverting to the mean, and see if they're still reverting to the mean. We'll look at that tomorrow. All right, I think let's conclude at this point, and we shall pick it up again tomorrow. If anybody needs to get hold of me, you've got my email address. Thanks very much, guys, and chat to you tomorrow.